So proud of us. That's good. 4 in a row. Let's keep it rolling. Love the consistency. Also, like and subscribe.
Like and subscribe. It's very important to us. Look, we're trying to do something here, and we're trying to just see where it can take us if we actually go all the way. Mm-hmm. And go all the way for us is just be as consistent as possible and keep pounding people with these clips. Pounding with clips. Just help us with our thing. Don't you want to help us with our thing?
We got a thing going on, and we're just asking for a little bit of help. If you wouldn't mind just giving us a little bit of help.
I mean, is that too much to ask? I mean, I'm just a guy. Al's a good guy. What the heck? Help us with our thing.
If somebody came up to me and was like, hey, man, I got a thing going on. Can you give me a little bit of help? I'd be like, sure, absolutely. I'll help you.
How can I help?
Why aren't you helping?
How can I help? Oh, here's how you can help. Take 20 minutes and just watch our show. Watch our thing. Like and subscribe. And share. You know?
Let us do your mortgage. Sell your house, buy another house. It's not that much to ask.
So it's just get all your shit together, put it on a truck, move your whole family so we can do your loan. And while you're at it, while you're doing all that, just like and subscribe.
That's it. It's not too much to ask.
All right, so let's get out of promotion mindset and let's get into the nuts and bolts of the show here, Alvin.
Love that.
First segment, ladies and gentlemen, is going to be we're going to take a quick look at interest rates today. So what's going on? So we always talk about the 10-year Treasury bond. Al affectionately refers to it as the T-bill. Mm-hmm. Mortgage rates are definitely correlated to the Treasury yield. Right now, it's at 4.414. That's out to the, what is that, 100th decimal point? So it being out to the 100th definitely matters. These little basis point ticks actually do matter. It's been bouncing up and down from 4.5 down, 4.5 down, 4.5 down. Hopefully, what we want right now, what we're rooting for right now, is for 4.5 to be the ceiling. We don't want it to get over 4.5. You can see here when it gets over 4.5, that's when it kind of runs.
It's actually in the thousandths, by the way.
Thousands.
Past the hundredths. We're in the thousandths.
So this dotted line here, if you can see, is 4.5. Right here where my cursor is. When it gets over that, it tends to go on a little bit of a run. We don't want to see that. We definitely don't want to see that run. If we can keep it below 4.5, we'll be able to hang on until something pops. Mortgage News Daily, they highlight the mortgage-backed securities and Treasury prices every single day. So this graph here is just a look at what the mortgage-backed securities are trading for. It's just look at it like a stock. You know, people buy and sell securities all the time, and the price rises and falls. So as the price rises and falls of those mortgage-backed securities, mortgage rates go up and down. The intraday rate trend tracker is intended to provide an idea of general direction of mortgage-backed securities that influence mortgage rates today. What is the effect of today? Really, nothing. No positive, no negative, no nothing. That's good stuff. We have, where is it here? A look at mortgage rates today. They post these. This is Mortgage News Daily's post. This isn't us quoting rate. These are just offered rates. So for the 30-year, this is conventional. I think they base these off of 30% down, 800 credit score, first-time home buyers. So it's an average of those qualifications. But if you meet those qualifications, you could expect your rate to be 7% for a 30-year fixed. It's about 6.5 for a 15.
Yeah. So, and that's all to say, first of all, with the mortgage-backed securities and everything, let's just get out ahead of this. You're not going to look at it, right? That's what Adam does. Adam gets off on that kind of stuff. Adam loves, poor choice of words there, but Adam loves digging into mortgage-backed securities, right? And you know what? Adam does that so you don't have to, all right? You just tune into the show and he'll tell you what all that means and how it correlates to what your interest rate's going to be. So, a little over 7%, not where we want it to be. Hoping it comes back down.
Not where we want it to be. Hoping it comes back down. I don't like that 7. Life's a lot easier when there's a 5 ahead of it. But sorry to if I bored Al or anybody that's watching. Maybe I shouldn't have led with the MBS tracker.
People are tuning out left and right. We're going to lose viewer from mortgage-backed securities.
Okay, so the next thing that has to do with interest rates, and it moved things a little bit this week, is the war in Ukraine. So another really exciting topic, and another thing that people are going to want to listen to. So,
That's just a ray of sunshine today. Keep it rolling.
So, all right. So here we've got a headline from Market Watch. Now, it's like some people will think, oh, these guys are talking about war and like they're correlating war to mortgage rates. Well, I don't know. We're not doing that. It's just something that affects things. So, Ukraine used long-range missiles, including U.S. supplied missiles, and it escalated tensions between Russia and Ukraine, the ongoing tensions. It did not de-escalate when they start launching missiles into Russia. And whenever there is a global threat, investors tend to move away from risky investments like equities, stock market, and toward safe haven assets like government bonds. So as investors buy more bonds, we see the yields decline and rates decline. That happened kind of midweek or early this week, where we saw a bunch of bonds being bought up and rates ticked down slightly, but it all shook out and everything's kind of like back to neutral.
When we quote them a rate on Monday, we say we can get you let's say a 6.875 at par. And then the following Monday, that 6.875 is costing a half a point. So like, whoa, why did that happen? This is exactly why. It's things like that kind of shift those rates up and down on a weekly basis, daily basis, really. So.
Yeah. So yeah, I mean, we're dealing with it from all angles, and it's crazy,
Yeah.
and I just want things to get back to normal. You know, whether it be worrying about nuclear war or just worrying about being able to afford home,
groceries. Yeah. Just a little bit of a side note, probably not the best thing to do, firing rockets into, the second largest nuclear power in the world, especially when they're spray painted with USA across the side of them. It's not good. It's not a good look for us, right? Not sure what we're trying to do, how that's gonna help things, but yeah, we'll see what it does for interest rates.
Yeah, let's end the world in the name of democracy. Like, look, come on. North Korea is sending 200,000 troops to Russia to defend, and you know what they're doing? They're just sending 200,000 young people there to die.
Right. That's it.
Just foot soldiers to be on the front lines and die. Like, launching more missiles isn't going to end the war or end death.
No.
It's only going to escalate it. It's really weird. It's really weird. It's really, really, really strange that like the answer is weapon. Like is for what, 2 years? Has it been 2 years or more?
It's been more than 2 years.
More than 2 years.
I
Weapons,
think so.
Weapons, money, weapons.
Explosions, death, destruction, explosions, death.
It's the WERP chart is the world interest rate probabilities chart. It shows where investors expect the U.S. benchmark interest rate to be after each Federal Reserve meeting. So this is like looking at betting odds, okay? This is a bunch of investors get together and they all vote on where they think the Federal Reserve is going to move their federal funds rate over the next, year, really. So if we look here on this hikes/cuts column next to the date, that's the probability of there being a cut. So if you go off of this and you're putting faith in these people getting together and voting on where they think things are going to go over the next year, this would tell me that it's a foregone conclusion that rates are going to be cut consistently.
Sure.
Over the next 12 months, over the next however many meetings that is.
So when you go to sleep at night and you're thinking about your future and whether or not you're going to be able to buy groceries, this is what you look at before you go to bed to help Hope your head rests a little softer on the pillow.
No, I mean, but it's just information, and I'm trying to provide information to you and whoever else is out there listening.
Yeah, I love that. Now, people also have to understand that you are in a room all day, a dark room with some sort of Russian techno music playing with like 6 screens blasted with just graphs and charts and things like that all kind of lead into how you feel about interest rates. That's what we picture. And you're just looking at your graphs and your charts and your dot plots, kind of figuring out what's going to happen next. But
the funny thing is, the more I pay attention to this stuff, the more I find that like they're all just throwing darts.
Nobody really knows. How many times have they been wrong? And you have some of the people that are the best in the industry at what they do and, reading the tea leaves, so to speak, and what we can expect in the future. People back in 2021 that were like, don't lock, hold out. Towards the end of 2021 that were like, nah, it's not going to go up. Everything's going to be fine. The rates aren't going up. And then 2 weeks later, we're like, we were so wrong. We were so completely wrong. And these are some of the the people that have produced the most, of any loan officer in the world or in the country. So,
and I mean, dude, none of the people that make those charts aren't even loan officers. They're big time investors, and they've got a lot of money at play, and I'm sure they take it serious. And so the last time I looked at that chart was like March or April of last year, and I remember it saying that there was 100% probability that they were going to cut rates in July, and they ended up not doing it until September, as we all know. So the thing was just wrong. And then you can also look at and read, different articles, and we've said this a lot. You can read different articles, and it'll be like, rates are going to go down, and we just hold out, and then they'll read another article and it'll be like, the housing market is going to crash, and rates are going to be up forever. So, you don't know what to do. So I guess sharing that information is partially to try and be prepared, but also to point out just that, like, no, they don't. They're just throwing darts at the end of the day too.
Yeah, it's a really good point.
All right,
and I don't read that stuff, so that's all on you. I just take what you say and I make surprised faces when you say it.
Yeah, man. All right, so I don't know. There's probably secrets out there, and they probably share them, and they probably know what's going on, but they don't share them with us. They just throw these confusing charts at us.
Yeah. That's it. And then watch us trying to interpret them. Look at these idiots trying to read our charts. Doesn't even make any sense. We just made this chart up. We were literally typing buttons in real time. Yeah. And this guy's like, oh, it's going up. It's going down. It's going up. It's going left. It's going right. Yeah.
Plus, they don't account for a war breaking out or,
Sure.
There's a million different things, or a pandemic, or a million different things that can happen. All right, so let's get into our last. I've got one more thing I want to share here for you, Alvin. And you know what? It's an article from New York Post. And I'm not generally one that likes New York Post. I think their website's annoying. I think their articles are stupid. But you're just not going to believe what the New York Post had to say in an article that I read today. You're not going to believe it. A lot of pop-ups. But you're not going to believe what it said. And I have to tell you that I agree with them.
Really?
Yeah.
Oh, my God. The tides are turning. What is going on?
Let's pop over here, and you're not going to believe what this article says, but Alvin, read the headline
Best
for us.
time to be a homeowner home buyer in 5 years? Right now.
Take it to the top.
Is the best time.
And cut.
For home buyers in 5 years.
Let's run that back.
Right now is the best time for home buyers in 5 years? Get out of town. Get right out of town. It's funny, too, because it's almost like we've been saying this. Didn't I say something about planting a tree? The first best time to plant a tree was like 5 years ago. Second best time is today. Same thing with buying a house.
Mm-hmm.
And now the New York Post is trying to pick up on my steam.
It's like you write for the New York Post.
Poster boy.
So, the New York Post and all other print media and legacy media are trying to keep up with the internet. They're trying to get clicks just like anybody else. They probably look at the views and the click rate, and they correlate what type of information gets the most clicks, and that is probably what drives them to write these articles. However, I do agree with this article. Can't stand the legacy media or New York Post, but this article is good. And I'm going to sum it up real quick for you. So they say that right now is the best time to buy in 5 years, and here's some of the reasons why. This is per their article, okay? Not me. Increased housing stock. Housing inventory has risen to 4.3 months of supply. It's the highest level since 2019. So although inventory is still struggling, it is the highest level since 2019, according to New York Post. New listings are up 4.9% year over year. So there's just more new listings, more for the buyers. So again, the headline of the article, best time to buy. So this reason is more on the market, more choices for home buyers, more leverage for buyers. It's not like there's only one house for sale in a zip code, and it's the only thing they choose from. They could go if you don't come to terms with the buyer, if you don't incentivize the buyer as the seller, then they'll just walk down the street. That's what causes a buyer's market.
Right.
It's all inventory.
Yeah.
Increased inventory simply means that they have more options to pick from. On just a mental level, that's better, but on a negotiating standpoint, that's much better.
Yeah. People giving away the farm, what I mean, to get a house. So
Yeah. So the uptick in inventory means that sellers are going to be more motivated if they have their house in the market and they want to get it sold. They have to be competitive to get it sold. This led to 18.5% of homes that are on the market saw price reductions with significant discounts, more significant discounts. It's like back to pre-pandemic levels.
Yeah. So, which is wild. I mean, you weren't seeing that for a long time, and homes weren't sitting long enough to have, they were generating so much interest, as soon as it hit the market, that you never really saw prices go down. But now you will see, if you're looking at houses on Zillow or Redfin or any of those, price cut by, $10,000, $15,000. People are getting really good deals on houses, which is great. And so that's going to keep values in check, right? So it doesn't keeps them from really surging up, which is what we're trying to avoid to a degree, you know what I mean, to help affordability.
Yeah, it depends on where your YouTube algorithm is or where your Instagram or TikTok algorithm is. It's like, if you click on stuff that says the housing market's going to crash, that's all they'll show you. Uh-huh. If you click on stuff that's like positive, it's all they're going to show you.
Right.
If you click on little people,
big world,
that's all they're going to show you. So I guess just be careful what you click on.
Yeah, it's a good way to put it.
So I have a personal story to share.
Love this.
That completely. I agree with the article we just read. I do think it's a great time for buyers. I do think that there's leverage that they didn't have months ago, leverage. I don't know. I think the inventory thing is way more dependent on market. Like Florida, there's endless inventory, and then in Maryland, it doesn't seem like there's much. So somebody in Maryland would probably say that article's full of crap. Specifically, I had 2 clients that I pre-approved over the weekend, and 2 completely different referral sources, 2 completely different clients. Both I pre-approved them both, and they both offered on the same house. I've never had that happen before in my career. And the other thing to note about this is neither of them got it. So
get out of town.
I don't know what the final offer count was, but one of my clients was very aggressive in their price, and they were both attractive offers, and neither of them got it. So
yeah, that's wild. And as a loan officer, you got 2 people that you pre-approved offering on a house. You're sitting back, obviously wanting the best for both of your clients, but you're like, one way or another, I'm getting a deal out of this. One of these people is going to win this bid. and then it doesn't come through, man, what a heartbreaker, you know?
Yeah, it's tough. It's tough. It's tough, and it's crazy because I texted one of the agents. Obviously, I can't and would never share that, I have two people competing. It's just like, hey, can you write a
Insider information. It's like
right?
insider
It's like
trading.
all I get is, hey, can you write a pre-approval for X amount of dollars, and I write it and send it off, and that's that.
Yeah.
But after we didn't get it, I said to one of the agents, like, what's the deal? Like, I thought our offer was pretty strong. And they're like, yeah, our offer was really strong, but it went to somebody who waived all inspections, and the house was like 1960s house. And and I said, is the market, or are we back to that point? And then he's like, I don't know. I don't. So it's like,
This is our property in Maryland, right?
yeah.
Yeah, because you're not seeing that in Florida.
No, Florida's much bigger, and there's a lot more.
You don't say. Get out of town.
There's a lot more
acreage wise.
Yeah, just a lot. There's just a lot more new construction. There's a lot more resale. People are coming and going. It's a transient state.
Yeah. That's wild, though. That is wild. That just gives you a little insight into the ups and downs of the industry, right? That's an industry insider right there telling you these are the things that are coming at you, the highs and lows of your emotions, right, on a daily basis.
Yeah.
2 files CTC one day, and then you lose a deal later in that day.
Mm-hmm.
Just got to stay here.
Mr. Even Steven.
I
get a file of CTC, and I get somebody falls out of contract because of an inspection.
Mm-hmm. Yeah.
I lock somebody because rates dipped a quarter of a point, and the other person shops me for an arm.
Point. Yeah. And I am the type of person, it's just who I am, that I ride the roller coaster. I am 100% on board the roller coaster. The highs are just the woo, and the lows are just, it's all coming to an end. You know what I mean? I need to do something else with my life. So, 2 different kinds of people.
Yeah, I think there's times when you feel like, I'll never get another phone call. That's how it's kind of been like in the last 2 years. It's like there's times where rates pop up half a point, and everybody puts their home search on hold, and it's radio silence.
Yeah, which is a far cry from where we were just a few years ago, where, I mean, you walk down the street and you bump into 3 people that wanted to refinance or buy a house. You know what I mean? You couldn't talk to enough people. Couldn't pick up your phone quick enough, right? Mm-hmm. So, yeah. But this is the business we have chosen. So,
Alvin, why don't you take us out?
Yeah, so this has been That Mortgage Show. I've been Al. He's been Ab. We are here for you. We love you. We want to help you. If you're looking to buy, if you're looking to refinance, if you're just curious what you could afford, give us a call. Shoot us a text, right? Pop us an email. We're here for you. Watch the show, like and subscribe if you're here for updates. And we will keep you posted on how the market goes. But one thing we can say for certain is right now is the best time to buy.